Welcome to the Economic Rockstar Podcast with your host, Frank Conway, connecting brilliant minds in economics and finance.
Today's featured guest comes from Kansas City, Missouri. He is a professional trader, educator, and entrepreneur with more than 10 years' experience in the financial markets. Jason Stapleton, welcome to the Economic Rockstar Podcast.
Thanks, Frank. Thanks for having me.
Jason is one of the founders of Trade Empowered and a managing partner of Harborsite Capital. Jason's heavy focus on trader psychology, along with his in-depth knowledge of advanced technical analysis, gives him the unique opportunity to work with traders of all skills and levels, helping them to achieve a higher level of success and understanding in the foreign exchange market. Jason, I've given our listeners a little overview, so please take a moment and tell us about you personally.
Okay, about 10 years ago, I was working in Iraq, of all places, and it was during right after the wars had kicked off over there, and I was working for a company doing security there for U.S. diplomats who were part of the Provincial Reconstruction Team. And what that means is basically they had folks out there who were building roads and who were digging wells, and it was a pretty dangerous place back then, and they hired guys like me to go out and provide security for them. And that left me with quite a bit of money and a lot of time on my hands, and I had always had an interest in the financial markets, and I started playing around with it and ended up losing a lot of money. And but through that process, found something that I really loved doing, and over the course of several years of practicing, I got pretty good at it, and said to myself, well, I wonder if I could do this for a living. And I got to a point where I felt confident that I could, that I could make money. And so I went home and I started doing it professionally. And I realized very quickly, I had kind of a vision in my mind of what I wanted my life to look like. And I had this dream of coming home and being in with my family and spending my mornings trading, and then coming up and eating lunch with my kids, and then going out and playing golf or something like that. And I realized very quickly that that was not the life that I wanted, and that I was very much a people person, and spending my life in a basement, not talking to anybody, not interacting with anybody was not my idea of a good time. And so I started to shift my focus a little bit, and I had several conversations with traders that I knew in the industry, and one of them who had been a mentor of mine many years before that was also teaching trading. And I asked him a little bit about it and how he liked it. And I said, I'm thinking about doing something like this because I'm interested in, I want to be able to interact with people. And I think I can help people, and I wouldn't mind doing something like that. So he said, yeah, that sounds great. I'll tell you what I know. And so over the next year or so, he and I kind of talked through that process and what it looked like. And finally, I don't know whether he approached me or I approached him, but basically we just said, hey, we kind of like working together and we got a good relationship. Would you be interested in partnering? And through that discussion, Todd Brown, who's my business partner, he said, yeah. And so we kind of put together this little company that ended up being Trade Empowered, which is the company that I now manage with him. And we basically teach traders what we know and what we've learned, and kind of try and build a roadmap for people who are interested in doing it, and doing it the way that we both did it, which was on the retail side of things. Todd's never worked for a large house. He did do some stuff with some proprietary trading firms in Chicago, but in terms of actually working for a bank or having degrees in finance, neither one of us are like that. We really did it as a grinder, kind of grinding it out and learning what to do and what not to do from our basements or from our living rooms. And so I've been lucky in that respect to have come through the mire on that side, and I try and impart what I know and what I've learned over the course of that time to people who are trying to do the same thing.
It just goes to show how persistence and the dedication to remain focused actually pays off. Jason, also seeking the right mentor is critical for success. Have you in the past looked up to anybody or studied any books that you could credit for helping you get where you are today with your trading?
Oh yeah, absolutely. I've had Todd has been a great mentor to me and a friend, not just on the trading side, but also just in general. He's just been, we've been very good partners, and he he was one of the people who really helped me understand the psychology of trading and understand that on a way that I had never understood it before, and how much of a role the mental aspect plays. And there's another great trader by the name of John Carter who trades options. I really enjoy what he does, and I've learned a great deal from him. And Larry Hyatt, who is a systems trader. I don't know him personally, but I've derived a great deal from reading his books. Mike Bellafiore from SMB Capital. Phenomenal insights in his book, One Good Trade. And so I tend to latch on and try and grab knowledge from people who I know are doing a good job in the field. And it's not that I absorb their trading strategies or I do exactly what they do. What I try and do is understand why they're doing what they're doing. And that's one of the things that I try and teach traders who come to me is it's not really important that you do exactly what I'm doing. The important thing is that you understand why I'm taking the steps that I'm taking. Because ultimately you're going to have to kind of find something that you really feel comfortable with. You're going to, do you want to go into that day trading niche, or do you want to be more of a swing trader or even a position trader where you're basically doing investing, but you're going on the long end, short side of things?
So I gather that you're actually a systems trader who trades technical positions. And also, do you day trade?
Well, I don't do as much day trading as I used to, just simply because the business at Trade Empowered takes up quite a bit of my time. I am actively involved in the markets with some of my clients every single morning, and I kind of show them what I'm trading and why I'm trading it. I think everybody who is a trader needs to be a quote-unquote systems trader. Mm-hmm. Now, that doesn't necessarily mean that you need a trading system in the sense that everyone thinks. So what it really means is that you have a methodology that you're using, because the only way to create a competitive edge in the market is to be able to do something over and over and over again and be able to predict with a degree of certainty what the outcome is going to be. So it's not that you know that every time you take a trade that this trade's going to be winner or a loser ahead of time. What you know is if I take this same trade setup every single time I see it, over the course of a month or 6 months or a year, I can predict what the probability is that is going to be a winning trade. And so we start working in probabilities rather than in certainties. And once you realize and come to the realization that nobody knows what's going to happen, I can't put a trade on and know whether or not that trade is going to be a winner in advance. What I can tell you is what the probability is that trade is going to be a winner. And so by teaching people to focus on why they're doing what they're doing, it helps to create a roadmap that they can follow.
Putting time and effort into developing a trading strategy that works seems to be the key to successful trading. What advice would you give to traders about the benefits of backtesting and developing a trading strategy?
It's a good question. The real benefit in backtesting, in my estimation, is the psychological aspect. There are a lot of programs that can run backtesting for you. We use a lot of that stuff internally at our office when we're developing trading strategies. Todd is the systems developer in our company, and he spends the vast majority of his time testing and refining trading strategies that we think might show promise. But for the independent trader who's trying to learn how to be consistently profitable, the real value in backtesting is the amount of historical perspective and the amount of the psychological benefit that one derives from doing the backtesting manually. What I mean by that is most traders have a very limited window of time in which they've been trading, whether it's 3 months or 6 months or a year or 3 years. It's very narrow. And so they have a very limited amount of historical perspective. They've only seen things maybe once or twice, or they may have seen maybe they've never seen certain conditions. For example, right now in the currency markets, the average true range of the market on the Euro USD is something like 50 or 60 pips. And if you look back to 2008, 2009, that was 200 pips. So the volatility that was there just a few years ago has now evaporated, and doing things like day trading have become much more of a struggle just simply because the opportunity is not there. But when you get a guy and you take him back and you say, okay, I want you to back test all of this and I want you to do it manually, what they derive is all of that historical perspective, because they're manually taking every single trade and they're writing it all down and they're seeing it work for themselves. One of the things that we do when someone comes through one of the training courses, and I have several that traders go through, is we have them do all of the back testing manually to validate the system that they're using. So if you buy a trading system from us, the first thing we do is we say, yes, we do have the historical track record. Here it is. Now you go back and you test it too, and make sure that you get the same result that we got. And what happens is the guy goes back and he actually does that testing and he goes, holy cow, it actually works. If I take all the signals, if I do the same thing over and over and over again, if every time a trade is initiated, I take that trade, whether or not I have 4 winners in a row or 4 losers in a row, over time, I'm going to be successful. And the psychological benefit that a trader derives from that is just, you cannot pay enough money for it. And you can't get it any other way than doing the testing.
There's a lot of criticism coming from value investors and fundamental traders regarding the use of technical trading strategies, suggesting that they actually do not work. What defense do you have for using technical analysis in your trading? By the sounds of it, it seems to be a very successful means of trading markets.
Well, the first thing I would say is that if nothing against, it's not that I'm not a fan of fundamental trading. I think if you're trading fundamentally or based off of what you're seeing and what you're reading in the newspapers and seeing on television or whatever other fundamental strategy you're using, if that's working for you and you're making money, then stick with it, because you are doing something that's making you money. What I will tell you is, for most retail traders, and specifically traders, I'm not talking about investors, but guys who have a time horizon of 1 day to 1 month in terms of their trading. Even if you go out 3 months, you say, I've got a 3-month time horizon. In order to accurately trade based off of news and based off of fundamental data, you have to get 2 things correct. You not only have to know what the number will be. So let's say it's unemployment claims. You not only have to know what the unemployment number is going to be, but you also have to know how the market is going to react to that number. Now, the difficult thing about that is those are 2 things that you cannot possibly know in advance of the news event. So while one could potentially trade off of the news event once they know what it is, they still don't know what the long-term reaction is going to be of the people who are trading it. And we've all been in situations where we saw the market spike up 100 pips after a news event and then reverse 100 pips by the end of the hour, or points depending on what market you're in. And so what I tell traders is a chart is the visual representation of all market participants' actions. You are getting to see on a chart the decisions that people make, not what they talk about doing, not what they say they're going to do, what they actually do. And that is an invaluable asset when you know what you're looking at. And so rather than try and trade based off of 2 guesses that I cannot possibly know the answer to, I would rather be able to look at a chart and tell what the market has already done, what the individual traders have already decided, and then base my trading decisions off of that.
So the markets are typically made up of human behavior, and these price patterns are actually a reflection of that human behavior?
That's exactly right.
I personally love a quote from the poet William Blake, who said, "I must create a system or be enslaved by another man's." Do you have a mantra or quote that you religiously apply to your trading?
That's actually a pretty good one, because one of the things that you want is you want to own your life. One of the things that traders who come to me are all of them are trying to do is they're trying to gain some sense of freedom in their life, whether it's financial freedom or freedom from a dead-end job or freedom from a boss that they hate, or they're just trying to create for themselves more freedom. But what they end up doing is they end up shackling themselves to somebody else and somebody else's system and somebody else's signal service or whatever the case may be. And so I think that that quote, while not directly related to trading, has some real correlation there. One of the things that I have always said is know where you're getting out before you get in. Know where you're going to have stops, know where you're getting out if you're wrong, and know where you're getting out if you're right. Be able to define those before you put any money at risk. Because once you put money at risk, it's like you're wearing goggles, like beer goggles. I don't know if they did this at school when you were in your high school there, but one of the things they always gave us was the beer goggles, and they let you walk around. This is what it's like to have 3 beers, and then you end up stumbling around like an idiot. And they say, basically don't drink and get behind the wheel of a car. Well, after you put money at risk in the market, it's like you throw on your beer goggles, and everything that you see and everything that you experience is experienced through the prism of having money at risk, and it skews your entire perception of reality. And so what I tell traders is, know where you're getting out before you get in. Know where those stops are, know where those targets are. That way, you don't get into a situation where you're behind in a position and you're trying to figure out, okay, well, when am I going to get out? I don't know. Oh, should I do it now? It looks like it might turn around. I don't know. Don't mess around with that. Just have a place, get out. And if once you're out, you see, oh man, I really shouldn't have been out there. The market's turned. Then you can always get back in. But having those predefined stops and predefined targets helps alleviate a great deal of emotional stress during the trade.
It's important to filter out that emotional stress through these stop losses. Most traders have a horror story about a huge drawdown in the market that might have cut them out. Have you had any experience or a story that you can share with our listeners?
Oh, I've had several.
I think we'd love to hear about them. You had experience in options, then you tried stocks, and then futures.
Yeah, I've done it all. I lost the first $5,000 I lost, which to me was kind of all the money in the world at the time, was in penny stocks. And I thought I had it all figured out. I thought I had the inside line on the company, and it was going to blow up, and I was going to make. I actually took in a $5,000 investment, and when the stock actually got shut down, it was worth about $20,000. And then in a matter of about 3 seconds, that $20,000 was worth nothing, because the SEC ended up shutting down the company that I was trading. Wow. And it really was an eye opener to me, to say that, you cannot rely on, nothing's a sure thing. You really are playing a probability. And I've had other significant losses. I remember that there was around the time of the flash crash, you were seeing some massive gaps in over the weekends in the currency markets, and I actually ended up getting into a position that gapped up a couple of like 150 pips or something like that on the open. In the currency markets, you only get one gap a week. It always happens on Sunday here in the United States when the markets open and close, because they run 24 hours a day. And so that gap instantly, and what happened was I had stops in place. So it gapped above my stops, which immediately generated a market order that was like 140 pips above where I wanted to get out of the market. And it cleaned my clock, totally cleaned my clock. And I actually get traders who come to me all the time who complain that the market gapped up on them, and they think it was their broker's fault, and they don't understand the way orders get routed or the way that the market actually works. And so rather than being mad at themselves or just throwing their hands up and saying, you know what, the market did me one, they end up looking for somebody to blame. Mm-hmm. And that is I know you didn't ask the question, but that's a real common problem among virtually all the traders that I end up working with, is that all of them are tending to look outside of themselves for the reason that they've been a failure. It's because my wife doesn't support me enough. It's because my broker's ripping me off. It's because, I don't have the right system, or I just, the last guy, who told me he was going to teach me how to trade screwed me over. And one of the things that I spend a lot of time trying to get people to accept is that the reason they haven't had the success that they want is their fault. They're in complete control. No one else is placing the trades but them. And if they're turning their money over to somebody else, or if they're continuing to make bad decisions, that's nobody's fault but their own. And it's amazing when people take personal responsibility for that, the change that can then ensue. And so, but yeah, there's a huge problem with, I think we as human beings don't want to admit that we're the problem. That the fact that we're fat is not because McDonald's has greasy cheeseburgers. it's because you like to roll through there 3 times a day. And so the sooner you can admit that you're the cause of your problem, the sooner you can get to the solution.
Fantastic advice. You're the survivor. What's the one trade, big or small, or technical, that stands out to you to be your best trade to date, or the one that's most memorable? Was it your comeback?
Yeah, no, I don't know. I remember one trade in particular where we had a huge Gartley pattern. I'm a pattern trader. I do both structure trading and pattern trading. And a Gartley pattern is a specific type of pattern that occurs. And I think it was either the New Zealand yen or the New Zealand dollar that I was trading. Massive pattern. And I ended up getting long, and it was just beautiful. It was like at the tick, the low, I bought. And I watched the thing rally like 300 or 400 pips. And I rode the thing all the way up. And it was the greatest feeling in the world. It was several weeks of just holding this position and riding that wave. And it was definitely one of the most successful trades, because I don't tend to hold trades that long. But it was a really good feeling to close that out, not just because of the money, but because at the end of the day, you knew you'd done it right, that you had done the analysis correctly, that you had identified what the trade was, that you had, stuck to your guns and you'd been disciplined, and it had paid off. And I try and I keep saying one of the things I try to, but we do so much work on psychology and on discipline in the work that I do with traders. We focus a lot on asking a very simple question at the end of every trade. It was, did I follow my rules? That's the only question that you need to ask. Did I follow my rules? If I did, then pat yourself on the back because you've done a good job. Because if you've done everything else you're supposed to do, if you've tested your strategy, if you know that it's effective, if you've been trading consistently, then you should get the same outcome. So the only question that you need to concern yourself with is not whether it was a winning trade or a losing trade, but whether or not you followed the rules. Because if you followed the rules, it was a good trade.
That brings me to a Wall Street adage: cut your losses and let your profits run. How does a trader decide where to take their profits or losses? I understand you mentioned about stop losses, but how do you know when your trend or your momentum play or your contrarian play is actually coming to an end?
Well, the nice thing about technical analysis is that it will tell you when the trend has come to an end, because you'll see structural breaks in the market, and there are a lot of different ways to identify that. One of the things that there's the question that you're asking is, there's not a simple answer, and I hate doing that because I want to provide clear-cut rules for your listeners. But unfortunately, it depends entirely upon the system. You may find that taking one of the things that we look at, for example, is we look at, on average, how far does the market move before a 5% correction. So let's say that on average, using the time frame and the strategy that we're kind of using, that from the point of entry, we will move somewhere around 200 pips before we will get a 5% correction. Well, as soon as we get to 180, 170, 180 pips, we're going to start tightening those stops way up, because we know we're reaching about the max that we can possibly get out of this particular trade on average. And again, we're just simply playing probabilities here. Mm-hmm. And so we can tighten those stops way up. Another time we might use an indicator like a fib dot trail that just simply says, all right, I'm going to just ride this thing until we get a 382 retracement. And then once we hit the 382 retracement, I'm going to get out. It's basically a Fibonacci sequence number. You might look at structure and say, I'm going to continue to ride this lower until structure is broken to the upside. And any one of those can produce you a profit. You just have to use them consistently. And that's why I say you've got to have those, you got to know where you're getting out before you get in. That way you don't get into a situation where you're like, oh, I missed it. I should have got out yesterday, or I should have got out 5 minutes ago, and now the thing's continuing to go against me, and I really don't want to take this loss, so I'll just cross my fingers and close my eyes. That's not where you want to be.
No, that's a great takeaway. It was just actually leading into my next question, but you actually covered it. Successful traders apply an exit strategy before they actually enter any trade. So it eliminates the emotional or the psychological effects that any change in market conditions can have on them, whether it be a drawdown or a sudden increase in prices. At least they know prior to entering that trade they need to exit at any certain level. Let me ask you, any other personal risk management rules, and what advice would you have for our listeners?
One of the things that we do is I don't look at risk management on a trade-by-trade basis. I look at it on a portfolio basis. As I said, we do a lot of testing before we trade anything. I want to know that what I'm doing is profitable, and I want to know, and I don't want to trade just one currency pair. So I'll trade whatever I'm going to do it on a basket of currency pairs, whether it's 4 or 6 or 20. And so what I do is I take the basket or the portfolio and I run the strategy on the portfolio, and I say, okay, based on these 4 or these 6 currency pairs, what is the drawdown if I don't apply any money management? I don't do any position sizing increases or anything like that. If I just trade at 2 standard lots the entire way across, what does that look like? And then I say, okay, well, in that case, I'd have a 5% drawdown. I'd end up with 40% at the end of the year. And I kind of start basing, kind of a rough shell of what that looks like on the portfolio. And then I say, well, what if I increase my position size every time I hit certain thresholds? Then what does that do to my drawdown? What does that do to my potential return? And so everything that I'm doing is based on the portfolio. So I don't look at it and say, well, on this particular trade, I've got a 100 pip stop loss, and on the other one, I only had a 50 pip stop, so I need to adjust my position size. What I do is I take the entire basket and I run a position sizing model based off the portfolio. And what it does is what it should do is it should smooth the equity curve. That's the whole reason for doing it. And so we do it a little bit different, and I have money management strategies that I teach and risk management strategies. But if somebody's just using, look, I'm not going to risk more than 1% on any trade, you got to take 100 losing trades in a row, at 1% in order to be bankrupt. Now you're going to be in trouble a lot quicker than that. But my point being is that you can afford to take some losses and not worry about blowing your account up. I always suggest that traders who are learning how to trade and who are not successful yet go into micro accounts. In the currency markets, you can drill all the way down, so you basically trade 10 cents a pip or 10 cents a point. So if you've got a few $1,000s, you can make that last forever, and you can virtually never go bankrupt. Now, you're never going to get rich, but you're not going to lose your shirt.
And you're going to be in the game longer, and you're going to learn from experience.
Yeah, that's exactly right. It's like we live we're playing in the biggest poker room in the world, and all you need is a chip and a chair. There's plenty of chairs. There's as many chairs as you need, but when you lose all your chips, you got to go home.
You can get the next part of this amazing interview with Jason Stapleton in episode number 2 of Economic Rockstar podcast. Hear what Jason thinks of the turtle trader story, CNBC and Bloomberg, internet chat forums for traders, and human psychology in the markets. Also find out what makes Jason the person that he is. And as a bonus, Jason gives us some amazing, actionable advice. So join us on the next episode of Economic Rockstar.